Phoenix Mills. It surged to record highs in trade yesterday. It's a bit of a silent mover. You don't usually spot it. The volume's not necessarily always the highest, but it does tend to move and does tend to move very well. If you take the last 5-year view as well, Phoenix Mills as a stock would have given you fairly impressive numbers or returns. The question mark only is, does this move or do the fundamentals warrant this rally? Jayesh Khilnani has gone through the company's financials to see what could be working for the company, and he joins us with a quick analysis. Jayesh, good morning.
Morning, Neeraj. Well, it's the commercial aspect of the portfolio that's doing really well for Phoenix Mills. So if you have a look at their entire portfolio scheme of things, you'll see that heavily tilted towards the commercial aspect. So they have operational malls, which has 6 million square feet, and they have under development malls, which they're going to add another 2 million square feet to their portfolio. Residential is at about 3.7 million square feet that they have, while they have hotels in which in all they have about 588 rooms or keys, as they call it. And they have office space, which is once again at 1.6 million square feet. So that's briefly snapshot of what their portfolio looks like. And if you look at the financials, those have been really impressive. If you look at the 5 years CAGR of revenue, that's grown at about 28%. Operationally 25% they've grown, and the net profit has also grown about 44%. But have a look at the last two lines, where the consumption business, the mall business that has shown a CAGR of about 20%. And the retail rental income, that too has grown at about 15%. So these are the impressive numbers, and the analysts also believe that the consumption business and the retail rental income, that will actually drive the business going forward. So if you have a look at FY18 snapshot, the retail consumption business, that grew at about 9%, and we had the rental income growth, which stood at about 13%. This is only FY18. But if we can have a look at what the analyst community or where they are actually projecting that the growth will come in from the markets, so that will be three key markets, which is Bangalore, Mumbai, and Pune. So that's how the analyst recommendation screen looks like. Really impressive, because they have no hold or sell signals. There are 10 analysts who are covering this stock. All of them have a buy rating, and the return potential, well, that's only about 1.7%. That is primarily because we have seen the stock move up in the recent past. But have a look at this graph over here. That's the 5-year graph, and this is dominated by the green screen, wherein you have very less number of holds and less number of sells over there as well. So what I did was also look at some of the brokerages and what they have to say, what kind of target prices they have. So the first one, if we can have that one, we have what they're saying is that target price is about 746, wherein they expect that the business growth will be driven by the strong rental income, which will be across the markets that they operate in, the cities that they have, and also that the cash flow has improved, which can be utilized for the company going ahead for deleveraging as well. We have one on Motilal Oswal as well, wherein again they have a target price of about 737. What they say is that the key aspect over here is, and it's given in their presentation as well, that most of their malls will actually come up for renewal for the next 3 years. So that will actually drive growth. And also they have development land available in Lower Parel, which will give them a potential of about 1.2 million square feet of development land. So overall holistic, how their portfolio looks like, financials, along with the analyst community, what they're saying.
Yeah, you know what, I just want to get that first plate, if we can get on the screen, which spoke about, or rather the third plate, which spoke about the revenue CAGR growth, the profit CAGR growth, and the EBITDA CAGR growth. Now, for everybody who is wondering why is it that Phoenix Mills is nudging new highs and has consistently gained, that's the picture on the screen. How many companies do we have that over the past 5 years, Jayesh, in that space have clocked in revenue CAGR of 28%, profit CAGR of 44%? CAGR 44% is not something that too many companies and large mid-sized companies with stable finances have done, really.
That's right, Neeraj. In fact, it will be very interesting to see if I can get a list of companies which have done better than this now.